Welcome back. In today's show, we're going to be breaking down the three most common investment styles. The first investment style tends to be one of the most popular and one of the most aggressive is active management. So what is active management? Active management is when a professional stock picker on Wall Street, or you may be a day trader, they're telling you that they have the edge over everybody in the world and that they can pick stocks to help you beat the market and help you earn significant rates of return. But there are some major flaws with this style. Matter of fact, there's a great story about when Warren Buffett, who is one of the greatest investors of all time, he offered a bet in 2007. He bet $1 million that a hedge fund run by professionals would not beat the Vanguard S&P 500 index fund over a 10-year period. And he actually won the bet. Furthermore, what the data tells us is researchers found that those funds don't outpace the market. Matter of fact, 96% of the time, those funds are more expensive. So you want to try to avoid actively managed funds because of the higher fees and the lower performance. Now, is there a place for active management? Absolutely. There might be specific sovereign funds or really wealthy people that are in the 0.00001% or pension funds or things of that nature where it requires active management. But for 99% of investors out there, specifically if you're listening to this, you're either close to retirement or in retirement, you want to have a strategy that's better aligned with your financial plan, that's not so focused on trying to guess where the market's going, and something that's more aligned with your financial plan. Now, the next style is what we call passive management, which I'm sure you've heard this before, but basically passive management is you buy an index fund or exchange traded fund. And what it does is it mimics an index such as the S&P 500, which is comprised of the top 500 companies in America today. Index funds don't try to beat the market or earn higher returns compared with market averages. Instead, what they try to do is they try to be the market. They want to buy the stocks of every firm listed on an index, and that index can be the NASDAQ, could be the Dow Jones, it could be the S&P 500, etc. They buy stocks of all these firms listed on the index to mirror them so they can try to get the same performance of the index as a whole. So with this style, there isn't much trading involved at all. So there's no getting in or out of the markets. Passive management is a buy and hold strategy. And history tells us that this strategy will most likely outperform active management plans 96% of the time. It doesn't stop there though. There's also other ways to invest. So there's another style that's called evidence-based investing. And this is a style that I incorporate in my personal finances. It's also what I typically recommend for our wealth management clients for the most part. And so with evidence-based investing, this approach doesn't fit cleanly into the traditional passive indexing category. It also doesn't fit cleanly into the stock picking active category either. It's got some similarities to both, but it's altogether a little bit different. So evidence-based investing, it's based on decades of academic research and data. It applies Nobel Prize winning theories and empirical research that have been academically proven to work in the markets. So these portfolios can be constructed in a way to pursue certain dimensions as we call it in the investment world. So for example, stocks that are small cap, those are smaller companies that have less than $2 billion of revenue, a couple $100 million in revenue, give or take. They're somewhere in between that. But these are companies like Shake Shacks of the world or Redfins, or at one time Zoom was a small cap stock. GNC Supplements, for as an example. These are stocks that have a lot of potential to grow in the long term, to have higher expected rates of return versus the more established large cap companies like the Googles and Amazons, Metas of the world. So going back to how these portfolios can be constructed, so we can take stocks that are small cap, we can have stocks that have really good value, and companies that have great profits. So not to get too technical, but investors can pursue higher returns through a low-cost, well-diversified portfolio that targets these dimensions. And so there's really 4 points that I want you to take away here. So first, if you Google a small cap index investment performance chart, and I'm gonna pull a chart up right here so you can see. If you look at this chart, what you'll see is that small cap companies outperform large cap companies over time. And you might wonder, well, why wouldn't you just create a fund with more small caps? Well, that's a good point. The second point is Warren Buffett's philosophy. He became a billionaire by buying companies that had good value. So on paper, the stocks Warren chose, they looked a lot better than what the stock market said they were worth. And now the third point is research shows that companies that are already profitable, have a clean balance sheet, will outperform companies that aren't profitable. So evidence-based investing, it takes Nobel Prize theory in economics and it applies that to your portfolio. So if you look at this chart I'm going to share with you as well here, you'll see that having a tilt to small cap value in profitable companies, if you will. If you want to think of this as like an ice tray, and if you have all of these different types of investments, you have large cap, small cap, mid cap, you have growth companies, value companies, etc. If you just look at this as metaphorically speaking like an ice tray, and you know when you fill up an ice tray, if you just tilt it this way, you're going to have the water spill this way, or it's going to fill up these little areas first. So that's what we're thinking about. So with your investments, we're still going to hold a globally diversified portfolio. We're still going to have large cap companies. We're still going to have growth companies. But if we look at the data, we look at the numbers, what we're seeing is that portfolios that have a greater tilt to these dimensions that I'm talking about have a much higher success rate over the long haul. So the final point when you're thinking about evidence-based investing is you want to invest in a globally diversified portfolio. So not just US stocks. We just never know which country is going to outperform year to year. So it's best to own the market in totality by holding a globally diversified portfolio. And if you do that, you're going to position yourself to capture returns wherever they occur. And again, a perfect example is this, because a lot of times people are like, why wouldn't I just invest in the S&P 500, Eric? Well, you could, you absolutely could. But again, we're not positioning ourselves to be successful. If we look at, for example, a time frame from 2000 to 2010, in the investment world, we call that the lost decade, where if you would have had all your money in the S&P 500, you would have returned zero. A lot of that had to do with the financial crisis, terrorist attacks, Y2K, etc. So there was a lot that went on during that decade. But however, if you would have had a globally diversified portfolio mixed with global stocks and global bonds, you would have been positive. You would have been close to 7% versus flat earning zero. That's why we want to have a globally diversified portfolio, because we just never know which country or what have you is going to outperform and who's going to underperform. So we want to just own everything so we can capture everything. Global diversification, it can definitely broaden your investment universe. So you should practice what I call smart diversification. So rather than just owning, again, our home here in the US, rather just holding the S&P 500, one country, you should own a global market index portfolio like the MSCI ACWI, which is 49 countries and over 9,000 different publicly traded stocks. So bringing this home, when we look at the past 40 plus years, evidence-based portfolios, they've dramatically outperformed the other styles. So it's not just a fluke in the data. And then also with this style, it's bringing in together just a really smart way of trading, because you have to think about trading costs and all the different players in the market. You got to think about what's the best way to trade these portfolios to pursue the academic research, because just because it looks good on paper, it doesn't mean that you could actually trade it effectively without running up tons of trading costs, and there could be some market timing errors, etc. So it won't really make sense for you to implement this if you don't have a solid trading plan or a technical strategy to make this happen. So there are many firms out there, they're trying to combine those two together. and balance it out. So, what does the research say about what has done well over time, and how do we incorporate that? But also, how do we properly trade it effectively to be successful? So, in my opinion, if you're going to try to do this evidence-based strategy, you really want to do your research around the different money managers out there. There are a handful of really good fund managers out there. I can't give you that advice here specifically, but you could just Google evidence-based asset management firms, and you can do your own research there. But there are some really good companies there that are trying to implement this strategy, have been proven to be successful with this strategy. Again, partnering with the academic world to make this work and help you be more successful with your investment strategy. So if you don't have access to an evidence-based portfolio through your 401k at work, then I recommend just buy a low-cost index mutual fund, try to make it globally diversified, or buy a exchange-traded fund that's globally diversified, low cost, and try to do your best to buy the small caps, the values, the profitable companies, and again, try to make it global. But if you need help with this, if you have any questions, drop them in the comments below. But if you want to learn more about how you can implement an evidence-based portfolio for yourself with your assets, feel free to book a call. You can go to my website. You can go www.wealthbllc.com. It's also in the show notes. Feel free to book a call, and we can walk you through all the different strategies to see if this could be something that could work well with your overall wealth plan. So thanks again for joining me today, and I'll see you on the next episode.